Now, starting from illustration 18, for the next 4 to 5 illustrations, these are actually not specific scenarios that are covered by the standard, but these are basically interpretations that have evolved over time. All right. These are basically interpretations that have evolved over time based on actual practical scenarios that people have actually encountered. All right. These are not necessarily all going to be available or based on the text of the standard. They're basically, some of them are included in the text of the standard, but a lot of them are based on interpretation and guidance that have evolved over time. And therefore, you might not necessarily understand or comprehend it fully. All right, there are diverging guidances available as well. Like some person might be of one opinion and another person might be of another opinion. All right, just like how in income tax you might have judicial case laws where one person may have one opinion and another person may have another opinion. These are certain examples where different people can actually have different opinions, but what we are actually going to read in the institute is not are not two different opinions. There's going to be only one answer given, but I'm just letting you know that in some scenarios few people may actually be have some opinion and others may have a different opinion, but we are obviously going to read whatever the institute has given in the study material. All right, so let's look at illustration number 18. On 1st January 2021, NKT Limited subscribes to convertible preference shares of VT Limited. All right, VT is basically the issuer and NKT is basically the holder. All right, so VT Limited is issuing convertible preference shares which are held by NKT Limited. The conversion ratio varies as below. If the shares are converted up before 31st of March 2021, then it is going to be the conversion ratio will be one equity share for one preference shares. All right, so VT Limited will be obligated to issue one equity share for every preference share. If the conversion is taking place, let us say before 30th of June 2021, if it is taking place after 31st March but before 30th June, the conversion ratio will be 1.5 equity shares for every preference shares. All right, so the conversion ratio up to 31st of March 2021 is 1 is to 1. After that, it's 1.5 is to 1 before 30th of June. And if the conversion is taking place before 31st of December 2021, the conversion ratio will be 2 equity shares for every preference share. All right, so it's going to be 2 is to 1. All right, so depending on what period of time you're going to convert, the conversion ratio will actually change. It can be 1 is to 1, 1.5 is to 1, or 2 is to 1. Now, the question is, will this convertible preference share be classified as a financial liability or will it be classified as equity? Now, remember what we actually read is an obligation to deliver a fixed number of equity shares will be recognized as equity. An obligation to deliver a variable number of equity shares will be regarded as a financial liability. Now, over here, when the conversion ratio is changing, all right, let us say the number of preference shares are 10,000. BT Limited has issued, let's say, 10,000 preference shares. If they are converted before 31st of March, the number of equity shares to be issued will be 10,000. If the number of preference shares are, if the preference shares are converted before 30th June, it will be 15,000 and later it will be 20,000. All right. So you might actually feel that a VT Limited over here actually has an obligation to deliver variable number of equity shares. VT Limited may actually have an obligation to deliver variable number of equity shares because it may actually deliver 10,000 or 15,000 or 20,000. The answer is it is not supposed to be looked at like that because time is actually not considered as a variable. Time is something which is bound to pass. All right, time is something which is bound to pass, and where the variability arises as a result of passage of time, it is actually not regarded as a true variable. All right, we actually don't regard it as a true variable. We will actually look at it as a fixed number of shares only. All right, at any point in time, all right, at a single point in time, the company will be obligated to issue only a fixed number of shares. If the conversion ratio takes place before 31st of March, irrespective of what the share price in the market is, the number of shares to be delivered will be fixed at 10,000. All right, the fluctuation or the variability is not arising as a result of market price changes like in few of the examples we saw earlier. The fluctuation is actually arising as a result of passage of time, and passage of time is not considered as a variable. It is something which is bound to happen. It is a certain event, and therefore, at any give at any single point in time, the company cannot have an obligation to deliver either 10,000 or 15,000. All right, at any one particular point in time, it will always have an obligation to deliver a fixed number of shares. For example, if on 30th of March the conversion is happening, the company has to deliver 10,000 shares. If the conversion is happening on the 1st of May, it has to deliver 15,000 shares. If the conversion is happening, let us say on the 30th of November, it has to deliver only 20,000 shares. On any single date, there is no variability. On a single date, there is always an obligation to deliver a fixed number of shares only. Whereas in the previous examples that we saw, on the same date, depending on the share price, there can be variability. If the share price was 5 rupees, the number of shares to be delivered was X. If the share price was actually 50 rupees, the number of shares was actually going to be different. So on the same date, the entities in the previous example had an obligation to deliver either X or Y, which means they had an obligation to deliver a variable number of shares. But here on a single date, an entity would always have to deliver a fixed number of shares. There's going to be no variability on a particular point in time, and hence we are saying that this is actually an obligation to deliver fixed number of shares only. At a given point in time, it is always going to be an obligation to deliver a fixed number of shares, and hence the convertible preference shares will be classified as equity. They will be classified as equity. Let us actually read the answer. The convertible preference shares can be classified as equity in the books of VT Limited. The conversion ratio doesn't change corresponding to any underlying variable. It only varies in response to passage of time, which is a certain event. Passage of time is certain to happen, and hence it will be regarded as a fixed conversion ratio itself.